Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action. And now, AJ and Chris Shepard.
Hello, and welcome to the Westside Investors Network. This year, we're launching a new segment on the show, The Deal Deep Dive. These are mini episodes where our featured guests will share their unique stories on a specific deal they've participated in. We will go deep on all aspects of the deal, from finding it to making the offer, due diligence, and more. Do us a solid and smash that subscribe button, leave us a rating, and further your investing journey.
All right, Stephen and Marc, thanks for joining Chris and I today. I'll let you guys go ahead and introduce yourselves. Stephen, if you want to start.
Yeah, my name's Stephen McAdoo. I am a multifamily broker here in Jacksonville, Florida, with Franklin Street. Focus on B and C deals, anywhere from 10 units to 200 units and everything in between. Been a broker for about 3 years now, and prior to that, I was working in commercial real estate for a developer. And in the beginning of my career, I started actually in accounting and got my CPA license and started that was the beginning of my career path. But for the last 8 years or so, I've been in the commercial real estate space and now working as a multifamily broker. So born and raised in Jacksonville, so a lot of local market knowledge, and yeah, that's about it.
Awesome. Marc?
Yeah, just real quick, what's wrong, Stephen? The CPA gig wasn't sexy enough for you?
Yeah. Somebody told me I was making a big mistake. I kind of thought it was like a rude thing to say at the time, but I should have took their advice because they were spot on.
Fair enough. Yeah, so Marc Hassan, I'm the owner and broker Spectrum Realty Services here in Jacksonville, Florida. Like Stephen, born and raised. So I've got deep roots here in Jacksonville. Kind of came up the same way, started in development. 08 hit, couldn't sell some projects we had, started renting them out, managing them, and kind of like the reoccurring income of property management in between development deals. Still do development deals, but have a full service property management brokerage here in town. We do everything from residential, multifamily to associations and commercial property. So yeah, excited to be on the call with you guys.
Yeah, thank you, Marc. Of course, we've got Trent on the call, and then I'm Chris Shepard, principal at Uptown Syndication. And Marc, it's so funny to hear, property managers' stories of how they got into it. And yours is actually kind of similar to ours because we bought homes, and then essentially when we quit our jobs, we're like, oh, we can't get loans anymore. So we had to figure out how to get income and cash flow so that we could get more loans. That's how we became property managers. I know. Well, Stephen, I'm really excited to chat about this deal in San Marco. Yeah. Do you want to kind of give us a little bit of background on essentially the opportunity and the location and, how kind of the San Marco location is different than some of the other areas in town?
Yeah. And just to confirm that this is actually the Riverside area, but the areas are very similar in nature. So, and they're not very far away. So this is actually the Riverside Historic District, but San Marco is similar in that a lot of the properties are, 100 years old and historic in nature. So it's a very similar profile.
Okay.
But I'll tell you a little bit about this property. So it's in Riverside, like I just said, it's in the historic district. So there's some pros and cons that come along with that. The pros are that really, beautiful properties, streetscapes are really impressive, very, I would say distinct from the rest of, the city and a lot of these areas. But the con is that you have to abide by the local governing historic districts that put limitations on what you can and can't do with the property. So it's nice because it creates a, sort of barrier of entry to newer product. And, you kind of have, once you're in there, you got a good, I would say competitive advantage in being, central to the city and just having some really beautiful properties. But, the bad part is that when it comes time to replace windows or replace a roof, you can't just put, anything, you can't use any type of materials you like and do whatever you want. You've got to sort of, abide by, what they set forth as being acceptable. And if you wanted to, deter from that, you have to, present and make your case of, whatever you're going to replace certain things with. But that being said, it is, for a renter perspective, one of the most desirable areas in the city to rent. It's one of the few really walkable areas of the city. You've got a lot of retail nearby in the Five Points area. A tenant living in this property can get off work and, walk to the bars and restaurants that are nearby. That's really desirable, like I said, because it's just, you don't have that with a lot of other properties in Jacksonville. Jacksonville is very, very spread out land-wise. It's obviously huge, and, people are used to driving pretty much everywhere in the city. So that's another thing that I think is really unique about this particular neighborhood and this particular property. This property has been, heavily renovated. The current owner spent about $500,000 in CapEx, which is, pretty significant for a relatively small property of only 11 units. They bought this property a few years ago, and basically, as these units turned, went in and, essentially ripped out everything and put it back together again. So, most of the components were replaced in this property. I won't say 100% of every single piece of plumbing, electrical, and so forth, but the bulk of it was. Both properties were tinted as a precautionary measure for termites, which is, one thing locally. I don't know about how that is in your area, but
Interesting.
Here in Florida, that's something that you've got to be cognizant of. Some people mitigate that risk with the termite bond, but termites are just, wood destroying organisms, or something you have to be aware of when you're owning property here. So did have those properties tinted, had some foundation work on one of the buildings. Pretty much all the HVACs are newer, the roofs are newer. They did really nice finishes with, shaker cabinets, quartz countertops. They refinished some of the hardwood floors, and the hardwood floors they put in, the luxury vinyl plank flooring. And so really, really nice product. I mean, they're really, targeting that high end of the market and have achieved some pretty strong rents. The most recently signed leases in the 1-bedroom units that are just over 800 square feet are about $14.95 plus utilities. In the triplex next door, and the 2 bedrooms are very large, 1,300 square foot 2 bedrooms. Those are currently leased up at $17.95 plus utilities. And then there's a small studio unit above the garage, and they just signed a lease on that for $950 plus utilities. So at this point, the property is 100% fully occupied. And, it's more of a turnkey product that is going to be for somebody who wants to just, buy the property and really not, the time and money has already been spent really to get the property performing really well. And I wouldn't say this as much as a, valued play as it just is a, nice yield play for somebody who wants a really nice property in a good area that is going to be, get really desirable tenants and just be relatively easy to manage.
Yeah, the benefits of, it does sound turnkey, and it does. The other thing that it sounds like is that there's not much left to do to increase the value of the property. And
Sorry.
Oh yeah. So generally, like, we as the investors like to come in and do some of the work, not all of the work, because we want to be able to sell it to somebody who wants to be able to do some of the work as well and leave a little upside. So I'm excited to look at the deal, but that was going to be one of the things that, because it does look like a pretty decent deal on paper, but the ability to sell it to someone who, and still have some, I guess, meat on the bone left for them to improve the property, is one of the things that we really look for when we're buying a deal. But let's dive into the details of it. So it's 11 units. It's an 8-plex and a triplex, correct?
That's correct. Yeah. 8-plex and a triplex side by side.
Okay. So the way that we build out our analysis is we start over here in the target rent analysis. So based on the rent rolls, I was able to essentially pull $995 for the studio, and then an average of 1443 for the 1 bedrooms and then 1795 for the 2s based on the materials we got. And so that gives a total average rent on the 11 units at 1466. And when we are calculating our revenue, so we're just going to kind of look at the profit and loss here. So that from the marketing package, that's kind of how we calculate, how much revenue could be earned for the year. It's not necessarily gross potential rent, because obviously there's a difference between what the market is and what the leases are. So the GPR is a little, I guess, a misnomer there. And so I guess the first thing to talk about, when we're calculating what effective gross income is vacancy. On a property like this, that's something that, with Jacksonville being a very, very, I guess, popular destination and increasing in population growth, I guess I'll ask Steven first, and then Marc, what do you guys think vacancy would be on a property like this?
I would say typically, vacancy in an area like this, on a property like this, is probably going to be sub, 5%. You're probably going to have, pretty sticky tenants, not a ton of turnover, and the, units are in high demand. So I think it'd probably be, sub 5%. It is, around the holidays right now, and there's some seasonality at play. So I have seen, vacancy tick up recently, whether that's sort of a trend or if that's just, the seasonality of the market. It's too early to say, but I think that's kind of roughly what I see. But Marc probably has a, much better handle on that than me, because he sees a lot more than I do in terms of the, data on the properties he's running.
Yeah. So kind of jumping in, I think 5 or 6% is something that's doable, especially in this area. So in Jacksonville, there are 2 areas that are kind of meet the profile for desirable areas for, I guess, young people or young professionals. That's going to be the beach and Riverside. As Steven mentioned earlier, Riverside is one of the only walkable neighborhoods. It's also got, it's a hop, skip, and a jump to downtown. It's got hospitals right around there, financial sector, et cetera, et cetera. So you get kind of a mix of young professionals with, if you put it on one of those caricature type of maps, it'd be the hipster neighborhood. You get people who they want to get in somewhere, stick, and love the neighborhood, basically. And so that's who you're going to get there. So as long as you can turn the units quickly, you should get them rented quickly.
And when you guys are turning a unit and it takes longer than it should have because of tenant damage, is that something that's getting billed to tenants, or is that, something that the landlord just eats in Florida?
Yeah. So, obviously you have your security deposit, and you can utilize that to the best of your ability for things outside of normal wear and tear. But if there's something that goes beyond the normal wear and tear, you're then trying to collect from that tenant. And our means for collection are, number 1, sending them to a collection agency, or number 2, going down the road of filing a lawsuit essentially for the damages if they don't pay. And then at that point, you probably spent more money and time than you would have on just paying the damages and moving forward and getting it re-rented. So it's a little bit of both, but as long as you're doing your proper application screening, as and, doing the inspections as you need to, you can hopefully head off any major damages before it gets too far down the road.
To clarify the question, let's say that a tenant, their pet does major damage to hardwood floors and trim, and it takes an extra week to repair that. Are you billing the tenant for an extra week of rent, or is that the time that it takes to do the extra work, is that just something that's not recoverable?
Yeah. So if you're looking strictly at the time, that's never seen that be recoverable. Okay.
So sub 5% is kind of what we're agreeing for this particular area. If it's more of an Arlington area, which is going to be more near the college, might be a little less desirable area. Are you guys kind of projecting the same type of vacancy, or are you going to be, more or closer to 10% in those areas?
I'll let Stephen give his expertise based on some of his listings and things like that. But I would say in our experience, those are going to take longer to get a good qualifying applicant in place. And now there's pockets, obviously, in the Arlington area, but just based on that product type, it's probably going to be a lower rent for a similar size unit over there. And so the applicant pool is going to be a little less favorable. You can get it rented, but you're going to have more showings, more applicants, and it's going to take a bit longer. So I would say you're going to see an uptick in your vacancy.
Yeah, I would agree with that. Just anecdotally, a couple of my clients that own over in that area have echoed that. Basically, they get a lot of leasing traffic, a lot of people taking a look, and a lot of applicants, but it's typically a tougher barrier or tougher hurdle to get somebody that meets that, good credit, meets the, 3 times our income's 3 times the rent, and to hit those things. So it is going to take you a little bit longer if your screening criteria is tight to find qualified applicants. So I would factor in a higher amount of vacancy. I don't know if I'd go up to 10%, and and it really depends. I mean, obviously we're Arlington's a pretty big area, and so it really just depends. I mean, there's some really like desirable pockets of Arlington, and there's some some little bit rougher areas, but I would say somewhere in between that range. You're definitely going to be likely higher than 5%, but 10% would be high. So maybe to be fair, to probably put in 7 or 8% on some of those properties for the vacancy portion. Yeah.
Okay, let's move on to concessions or bad debt. I would expect, Riverside area, there's not going to be many concessions. And I would also kind of expect bad debt to be pretty low, just based on. So I wonder if I have put this in as loss to lease for the 4.5%. I think this just came straight from the marketing package. So it's probably loss to lease over the past year. But Would you guys confirm that, bad debt in this area is probably pretty low, and then concessions are also low, just based on how the population growth is going?
Yeah, I would say that concessions probably are pretty low, except for, this time of year, it seems like more and more of the properties, regardless of the areas they're in, are offering concessions, just because leasing traffic is slower, because it's, we're right in the middle of the holiday season. So that may, change. I would say typically, like we're in the spring, very likely to see, no concessions offered on these properties. And then bad debt, same. If you're doing a good job of screening the tenants in these areas, I think, typically, I don't see a lot of collection issues on these properties. It is more rare and very isolated incidents, so I would, probably factor in very little, if any, bad debt. But certainly, you're going to have some loss to lease, obviously, with long-term tenants and stuff like that.
Okay. And so going through the expenses, I feel like we can kind of highlight one of the questions I had was contract services. It's almost $500 a month. Is that for landscaping, or?
I think there's landscaping's in there. I believe there's pest control is in there as well. I think it may just be the combination of those two, which, landscaping, it's 2 separate properties. So I could see that being anywhere from, it really depends. Those costs seem to have increased a lot over the last few years on a lot of these properties. So, anywhere from as low as, $200 a month to as high as $300, $350, maybe $400, depending on how large the lots are and how intricate the landscaping is. I know they did a really nice landscaping package on both of these properties. So, maybe it's a little bit higher because of that. And then pest control is similar, depending on the level of pest control you're going to have. So if you have a termite bond that's baked in there too, those can be expensive sometimes to maintain. But Marc, what do you think about, what are you seeing on landscaping and pest control and stuff like that?
Yeah, I think you're right. First of all, on this property, you don't have a lot of contracted services. I'm assuming it's take out your own trash type of deal. There's not a dumpster or anything like that on site.
Yeah.
That'd be the only one I would think of. And, again, just looking at the site, there is some decent landscaping beds and things like that would kick it up a little more than the typical, mow and blow type scenario on some rental properties. So I could see that being a little bit higher than some of the other properties of this size. And then, exterior pest control and things like that. I think you're probably pretty close to where you're going to be at the end of the day.
Okay. So When it comes to the rest of the expenses, I'm kind of estimating insurance somewhere between 750 a unit to 1,000 a unit, depending on just, I would say, property age and but that's kind of just a variable thing that it is what it is. And so I think that the property owner is currently paying 8,600 for 11 units, which is a little more than 750 a unit.
Yeah, they were actually a lot higher than that on this property. And I introduced them to my insurance contact, and he had a carrier that came in that was a lot more favorable than what they currently had. But I would say, probably, well, not probably, I mean, the insurance line item is, here in Florida, especially, I know across the country, it's the same, but even here it's more exacerbated, is the fastest growing expense line item by far year over year. So that's something to definitely, be aware of and make sure that if you're growing expenses at 3, 4, 5% or whatever that may be, you may want to be growing insurance just to be cautious at, 10 or 15% a year, just to make sure you're not caught off guard.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Yeah. So Steve, do you remember when the insurance was underwritten, when that policy was put in place?
This one was literally like last month when they got this 8,600, which was, it was basically the insurance contact that I introduced them to has this one carrier that just entered the market. And, who knows how successful they'll be long term as a company. But right now they have been extremely favorable in the premiums. I would say probably if they didn't go with this one, the premium on this property, probably would have been closer to $12,000 or something like that, just due to the age and everything.
Yeah, I was anticipating it to be a higher number. That's why I was asking if you were going to tell me that it was put in place at the beginning of the year. I would say, okay, that makes sense. But if there's a new player coming in when everyone else is pulling out, that's a fantastic scenario to have right now. But yeah, I would definitely say you're going to see an increase come renewal time or come purchase time.
Yeah, I agree. I would probably budget for just to be, cautious because that number is so favorable. The current rate, putting in maybe 25% for the next year, maybe 15% for the couple years after that, just so you, like I said, you're not caught off guard and that line items, blow up your expense load.
Okay. All right. So insurance, we're basically talking about the two major costs here. So after insurance, there's real estate taxes. And I guess the major finding that I've found is that real estate taxes are by far the most expensive, line item in, when you're buying property in Florida. It's significantly higher than Portland and not something to be overlooked. And let me know if I'm wrong, but essentially you multiply the sales price by 1.75% and discount it by like 80 or 85%. And that's what your property taxes are for the next year.
Well, basically, so the way they're done here in Duval County, and I think probably most of the counties in Florida do a similar thing, but they get generally a sale triggers a reassessment for the year after the purchase. So, if you bought a property right now, then it'll get, if you were closing right now, it would get picked up next year and it would be based on the new sales price. Typically, and I would, always call the appraiser for updated information, but I actually reached out to him a couple weeks ago and, typically it's the assessed value is coming in about 80 to 85% of the sales price. And then that assessed value is then times by the current millage rate, which is, I think what you're showing there is pretty close. I don't have the exact rate off the top of my head, and then there's an early payment discount of 4%, which I think the majority of people take. So essentially, whatever that calculation is times 0.96, that would be the new property tax amount. And that what you have in there looks, pretty close. I can't remember the exact number, but I think it is about, $30,000 1,000 or so.
Okay.
Yeah. Yeah, you're pretty close there. The millage rate right now in that area is 17.0303. So
17. Okay. So
03.
I've got, okay. So that is still 17% of income, which is.
What are you guys typically seeing in Portland as a percentage of income?
We're doing a deal right now that's getting $60K a month and taxes are $45,000. So 6.2. It's about three times less.
Oh, wow. Yeah, that's substantial. Oh, that's interesting. I'm surprised the property taxes are that low.
There's a law against reassessing the property.
Oh, really?
Yeah. I say that again, Mark.
I said you're paying for the sunshine down here.
Yeah. So there's a law against reassessment, like even on a sale?
Yeah.
Huh, interesting.
Keep in mind that we pay taxes on everything else.
Yeah. So I moved back here from Chicago, Cook County. It was similar. It was like you got kind of dinged everywhere. Here, I guess we are fortunate that we have relatively low sales tax and no income tax. That's really nice. But I can't imagine that, I'd be interested to know, what it is on a percentage of value compared to other states. That'd be interesting chart to see.
The other thing I'd throw in there too is, again, I don't know how they do it in Portland, but there is a cap on commercial property. So if it's the same owner, they can only go up 10% a year unless there's a major renovation permit pulled, something that like a sale would trigger a reassessment. On the flip side, though, if values go down because of a dip in the market or something like that, you can actually contest the taxes, get in front of the tax collector and have it reassessed to a lower value, which would then reset. So that's a savings that would carry forward again for years because they can't go up more than that 10% a year. So we take a look at our property taxes on an annual basis to see if there's any arguments for a reduction. So that's something to keep in mind there. But if your pro forma is for a favorable market of anywhere up to 10% a year in property value increases, I would factor that into future year pro formas and increase.
Yeah. Yep. Same deal in Portland, but it's 3% on the assessed value. They can only increase the assessed value by 3% a year. So that might be the difference. And then, we can do appeals as well. Got to get those in the next 2 weeks. Otherwise, you'll miss the boat. All right. So management is just going to be a percentage of revenue, which is pretty standard. Mark, what would be a standard rate that you guys would charge on 2 buildings, 8 and in this really nice area?
Yeah. 11 units for a new client. I'm probably actually around 8%, plus leasing fees and renewal fees and things like that.
Okay. Turnover. There's no turnover in here. Generally, I'll underwrite it at like $150 a unit, just because generally it costs a little bit and you're probably going to see 1 or 2 turnovers a year at a property like this.
Chris, just to clarify real quick, the 8% that you put in was for repairs and maintenance.
Oh, there we go.
Glad there's someone here to keep them in line.
Absolutely. My goodness. Well, cool. So then, let's talk about repairs and maintenance. So a property like this, Stephen, you were chatting about how there's been significant, CapEx invested into this property. And so I feel like this is an area where, on a deal like this that can get massaged. First, the rules of thumb. What would you kind of expect for, now that all the work's been done, what do you think maintenance would look like per unit on a deal like this?
Well, since they are, pretty much all newer appliances, you shouldn't have a lot of appliance issues. Same with HVACs, same with, the roof. So I would say, it should be lower because of a lot of those things. However, it also is, an older property. So there's probably some offsetting, things in there where, due to the age of the property, I would say, typically if I were underwriting a deal, I'd have that number a little bit, larger than I would, newer age of construction. But like I said, that's kind of, wiped out by the fact that a lot of these, things have been replaced. So, typically, you could use as low as, $500 per unit, per year on, if you think that everything's really been done and stuff's newer and you shouldn't have a lot of stuff, or you could use, if it's an older property that maybe there hasn't been significant amount of CapEx work done and you're going to have recurring stuff along the way. You can have it as high as $850, $1,000 per unit per year.
Mm-hmm.
I would probably pick something in the middle and use about $750 a unit. I think is probably a pretty good, rough estimate, for a property like this.
Marc, what do you think?
Yeah. So, look, obviously, Stephen knows the property better than I do. When I look at it from a location standpoint and an age standpoint, those are the two things that I pick up on right away. It's an older building, so I'm sure they fixed everything they saw, but what didn't they see? What hasn't happened yet to the building, so on and so forth? That's kind of an unknown. Obviously, you can do your due diligence as best as possible going into it, but it is an older building. The other thing is it is close to the river over there in Riverside. That's right down the street from the St. Johns River. We've seen hurricanes and tropical storms and everything year after year. That's most likely going to eventually you'll have some shingles blow off, or you'll have, something along those lines happen due to either storm surges, high winds, so on and so forth. And with the insurance market, the way it is, if it's something, well below your deductible or something like that, you're not going to want to file that claim to deal with it. So you're probably going to take that hit yourself. So that's the only thing that I see other than the age that I would be a little concerned about is you're right on the water there, which again, from a marketing standpoint and a rental standpoint, is fantastic, but you may suffer some storms and things like that you would want to have something in there for.
Mm-hmm.
Yeah. So maybe we can up that to 1,000. Maybe we'll just press that a little bit more, just out of caution.
Yeah.
Okay. Which is about what the property was being run at previously. And I'm sure when you guys did the analysis, the CapEx got pulled out as capital improvements. So then you got water and sewer. Water and sewer is just it's going to gradually increase. I don't think we need to talk too much about that. And then replacement reserves, that's just something that the lender needs. So all in all, based on the, the marketing package, the expense ratio is 42%. And how do you guys feel about this being a rule of thumb, for a property kind of like this in an area like this?
I think it's pretty close. That's typically what I use for these smaller properties. If I'm just doing a quick, analysis, I usually use, I take, 45% of the potential gross, assuming that 5% is vacancy and 40% is expenses. So, you're going to net around, 55%. That's usually kind of what I'll use to just do some quick back of the napkin math. But, once again, like I said, Marc probably, sees, way more, than I do, is closer to it. So he probably has a better, handle on what he, thinks that number should be.
I don't disagree with you. I don't have a problem with that number. Actually, I kind of got stuck and I was looking back at something else on the utilities before you guys jumped into that. Is that the house meter stuff on there, Stephen, or are they individually metered, or how does that work?
Yeah, that's the house meter,
Okay.
Water and sewer, which I think, what does that work out to be? Let's see, 30, 10.
270 a unit?
Yeah, that actually looks a little low. I'm surprised that it's that low. I think usually I see probably closer to
the rule of thumb that I've kind of calculated is around 488 per unit.
488, which should be, trying to think of on a monthly basis.
You don't have those hot summer days when we got to keep our grass green.
Yeah.
So if it's just water and sewer and it's for the outside, which is again just the outside meters, that's your summer months you can get a few $100 a month.
Oh yeah. I think this particular property is unique because there's not a very big, actually there's almost no yard at all except for the very little small strip in the front. The sides, I know there's gravel, and then there's sort of a dirt lot in the back for the parking in the rear. But Marc's right. If you were having a property that had a larger lawn, to keep the grass from really just drying out and looking burnt in the summer, you really got to give it a pretty significant amount of water. So that's definitely something to keep in mind here.
I guess I'll update that to our rule of thumb to 500 a unit. So with the updated taxes and then, some small changes, actually lower property management fees because it seemed like there was a significant amount of turnover. Our version has around 48% of expenses to the kind of the like as is rents multiplied by 12 with a little bit of vacancy and a little bit of bad debt in the deal. So that comes out to a 94,000 net operating income. Steven, is that kind of like, that probably is a little bit lower than what you came up with, correct?
Yeah. I think that's a little bit, I mean, like I said, those expense numbers are probably a little bit more conservative than what I used. And I also, some of that loss to lease, you're going to, remediate relatively quickly on the income side. Yeah, because I have my projected income at closer to the 223 that you're showing. So yeah, I think that, my NOI was a little bit higher, taking into account that sort of increased number. I'm assuming that, when spring comes, you're pushing all those rents closer to a little bit or more in line with market, but good.
Yeah. So the market rents that we're projecting would be 1,100 for the studio, 1,700 for the ones, and 2,000 for the twos. And so that gets us to that 223 number. The problem is that, acquiring the property, their tenants are on leases and raising up the rents. I mean, at least in Portland, there's rent control. We can't even raise rents like from an average of 1466 to 1695. Like we can only raise 10%. So we could potentially raise from 1466 to about
1,600.
Yeah, 1,600. So we could get pretty close with that 10% increase. But
we don't have any problem here.
Yeah. So, I mean, acquiring a new property, like, is that, I guess, common practice to just raise rents to market,
I mean, I think any owner, and it really depends on your business plan. I talk about this, with people a lot, if you're approaching like a sale or refinance sometime, in the next 12 months, then you want to be a little bit more strategic about, showing a lender or a potential buyer that you've been able, kind of proving out where market rents are, and maybe you're sacrificing cash flow by, just getting the rent roll to a certain place, just, to have that the effect you want on a sale or refinance. But I think typically, if that's not the case, then obviously you're probably looking to maximize cash flow, and you're kind of being cognizant of where the market is and where you can take rent without causing, too much turnover in your property. But different people have different methodologies. Some people want to get the rent roll to, as close to market as they can, as quickly as possible, by whatever means possible. And some people would rather, know that turnover is expensive because of the repair costs and the amount of lost rent. And because of that, they sort of massage that over time. And it's really just a matter of, I guess, personal preference and how you like to operate your properties.
Yeah. I mean, on my end, on a property like this, it looks like they've done a great job on the rehab, and they're nice looking units. They got the hardwood floors. They got everything that someone who wants to be in Riverside is looking for. I'm taking advantage of that. I'm going in and raising the rents right away. That being said, obviously, you do have to be strategic about it. If you've got 4 leases all coming up in the same months, you may not want to be, testing the waters on all 4 leases on an 11-unit building all at once. So, I think you got to look at how the renewals lay out. I'd start with the first renewal coming up and pushing the market. And if I need to get someone new in, just kind of setting that tone, and I'm going to get max rent as quickly as I can.
And in your experience in that area, like, are you seeing 1-bedrooms garner 1,700 in this market?
I would say this property is definitely pushing. There's a property nearby, actually, it's a stone's throw away. That's a new construction property where the 1-bedrooms, they're going out at $2,000 a month, but it's different. It's a brand new construction, amenity rich. The nature of the property is different. So this property is unique in that, a lot of the 1-bedrooms probably are renting for a little bit lower in this surrounding area, maybe, $1,295, $1,395, just a touch lower, but they're also probably not as nice. And then, like I said, you've got, brand new construction property that's just about 100 yards away where they're getting, $2,000. And so this property is going to probably sit somewhere right in between there. Somebody who prefers maybe a smaller building and doesn't need all the bells and whistles of a newer building with a lot of amenities, but they also want, nice finishes. They want to really, they want new appliances, and they want, nice flooring and all of that. So I think that, the rent's definitely achievable. Like I said, it's hard to say right now because seasonality is definitely taking effect. But I think come spring, I think those are reasonable to be hit based on, the location and the level of finishes of the units.
So, yeah, with your strategy, Marc, I think that we can boost the year one projections. And so when we're looking at buying a deal like this, we have to figure out, what the debt coverage ratio is going to be to figure out how much, the property's listed for 2.25 million. And we need to figure out what's going to cover the debt, because that kind of determines how big a loan we can get. So at a 5% loan, I don't think we can get a 5% loan right now. I think we've got to get a 5.5% loan. So it looks like it's going to be a little more than 35% down. So looking like 37. Yeah. So down payment is going to be roughly 830,000. You can get a loan for about 1.425 million, which is ideal. You want to get over $1 million loan because that'll get you into the Freddie Mac small balance program, which is important. And then I'm assuming there's just going to be some sort of CapEx needed. And I don't know, 175 might be a little high. So let's drop that down to 50,000 because it need a little bit of funds to fund the operating account. Yeah. And looking at this, if we massage the P&L a little bit, change that back down to 3. So we're assuming a 3% rent escalator. Actually, let's bump this one up to maybe 5% this year. Okay. And I feel like year 3 getting average rents to 1780 seems reasonable. So basically, this is how we look at a deal now that we've got the P&L kind of dialed in and we've figured out how big a loan we can get. And it's all based on the P&L and how much net income there is. And so we're basing this off of kind of year 1, which is getting rents up a little bit higher. At 5% vacancy, 2% bad debt, and it's looking closer to a $120,000 NOI. And so when we look at that, we can take a peek at the average return and the debt coverage ratio. So looking at a sale at 5 years, essentially this is going to be a cash on cash deal, and the average return is going to be roughly 7% cash on cash. And that's just based off the 37% down payment plus 50K. And if we look at the exit, which also has a big impact on the return, assuming, and here's an interesting question. So the exit value, so kind of roughly as is numbers, the cap rate, we're calculating the cap rate to be about 4.5%. Steven, is that kind of in line with what you're thinking?
I mean, if it was a year ago, I would agree with that. I think since interest rates have started increasing so rapidly over the last year, that's probably way too aggressive right now. But everything's changing a lot. I mean, over the last 30 to 60 days, the 10-year Treasury has come down by like 75 basis points or so. So I mean, rates. I was seeing rates sheets from lenders on commercial loans with rates in the the mid 6s, and now I'm seeing rates back in the 5.6, 5.7, 5.8, which is at least better, but it's it's not the 3.5% rates we were seeing a year, 18 months ago. So honestly, trying to pin down a market cap rate now is probably one of the most challenging things about doing underwriting a syndication deal, because there's so much uncertainty around where rates are headed that trying to figure out what a market cap rate is and 3, 4, 5 years from now is really challenging. I certainly think that using 4.5% would be, if somebody put like a deal in front of me that they were raising money for and they had a 4.5% exit cap, I think that's way too aggressive,
So
but
I think we're estimating an exit cap at 5.5%.
I think that's fair. I think that's a good number to use. I mean, and this is, like I said, one of the nice areas of the city. Deals typically trade, lower end of cap rates that they would, for the entire, city. And, it was not unusual for a couple of years to see cap rates, sub 5%. So I think using, 5.5% rate, assuming that interest rates kind of normalize and over the next couple of years, I think that's a good defensible number to use.
Yeah. And if we pushed the sale out farther, I think you could get a little more aggressive on the cap rate just because you'd be able to time it a little bit. But since this would be, something disposed within 5 years, I think that we would have to get pretty conservative. So with that 5.5% cap rate, based on the net income at sale, it really only fetches, about a $500,000 gain from the current purchase, which over 5 years it makes it, more of a cash flow deal. Like you're not really seeing, if you're assuming a 5.5% cap rate, you're really not assuming much appreciation. And so that is kind of why this particular deal, has a little bit lower returns, especially when it comes to the IRR. And so it takes a certain type of investor. And the other thing about this deal that makes it a little tougher for us to do is that all of the work has already been done and there's nothing really left for someone who purchases the property to improve because the rents are, near the top of the market. So there's not really any value add that is left on it. And so we just kind of look for different assets, but I do love looking at deals like these and hammering through the expenses. And I feel like we did a really good job underwriting this with your guys' help. And so I appreciate you guys taking the time.
Yeah, thank you. I appreciate you having me on and love to do it again sometime on a different deal. Yeah, this is probably not your, the best deal to look at from the lens of a value add syndication deal, because it's obviously more of a, core turnkey deal for somebody to just, sort of buy and collect income without really doing a lot of work. But love to hop back on sometime and work through more of a value add type project with you.
This property held for, 10 or 15 years, like through a full market cycle, because I would say Jack's, like multifamily itself has peaked, and now there's going to be a little bit of a cycle where, interest rates aren't great, other asset classes become way more popular. But then eventually multifamily will, reemerge as the new hot asset to purchase. And then at that point, cap rates will compress and an asset like this will fetch, a premium. And it's just a question of, are you willing to wait for that 10 or 15 year cycle to happen?
Yeah, I'd agree with both of you guys. I mean, there are investors in town who look for these smaller multifamily deals and only want to buy in Riverside or only want to buy in San Marco. And they're not the value add people. They just want to add to their portfolio, or someone looking for a quick 1031. That's the type of buyer I see for this deal. And there are people out there looking for this type of deal. But you're right. It doesn't have the work built into it like investors who are value add focused are looking for. He did it up front, and I think he did a good job with it, but it's not something that's going to fit into your type of portfolio.
Well, thank you, Marc. Thank you, Steven. This is our first rundown on going through this syndicated deal analyzer. And I really think that going through it with the listing broker and our property manager has been, really, really helpful for us. So thank you guys so much.
No problem.
Thank you guys.
Thanks, Trent.
Yep. Have a good one.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.